We're sitting now at the end of May, and from a market perspective, market returns year to date are up about 6%. So we've had a reasonable time. If you annualize that, you're going to land up with about 13-14% for the year. The average since 2004 on the market is about 20% per year, and the average since 1994 is 15%. So we're tracking a little bit below that. But the market's run quite hard over the course of the last 2 or 3 years. And we're sitting at a point now where a lot of the big cap companies are certainly looking fairly expensive, or at least fully valued. So we're having to work quite a bit harder to dig through and sift through opportunities. We're spending a lot of time visiting companies to try and find ideas. And portfolios, I think, in general, will end up becoming a little bit more perhaps eccentric, with perhaps a few less of the big cap shares, which have been the big performers, and adding to that with ideas where there's company-specific things going on. In a universe of shares, there's always something to invest in, but we find we're having to work a little harder to find those shares. A huge determinant of what's going to happen in the market is the currency. We've got a structurally weak currency view, and we're in a number of shares which have that kind of exposure. And I think one has to watch that pretty carefully. One must remember that about 75% of the earnings on the South African stock market are not in rands. So what happens to the currency is a big determinant of the direction of the market. And ironically, contrary often to what people think, if the currency does weaken, that's very good for the stock market and stock market returns. It might not be that great for the South African economic conditions, but a fairly small proportion of our market is actually susceptible and sensitive to what's happening in the South African economy. So, as we always say, unless it gets really expensive, stay invested, stay in the market, and we'll try and find the opportunities for you. Rolfes is proving a problematic share at the moment. We like the business, we rate the management, it's got a good history and pedigree to it, but is really exposed to industrial South Africa. And in that space, volumes are tight, and business is tough when there isn't any volume growth, because it means that people are discounting for price, so it tends to impact both the turnover line and margins. But it's a good underlying business. It's got some quite exciting potential. And the intrinsic value of the business is significantly high. So we are a holder of Rolfes, and for the moment we're sticking with that. We think the share price is too cheap. The risk is that it takes some time for the share price to come back. Capitec is a recent addition to the investment portfolio. We stayed away out of the micro-lending space completely over the course of the last few years. Capitec in the last results have now confirmed that they have weathered the storm. And what we find particularly attractive about it is the rapidly growing transaction base of their business. So that's customers paying 50 to 100 Rand a month to have bank accounts. And they're growing that. They've got 12% market share. They've stolen all of that from the big banks over the course of the last 12 years. And we think they'll get to 20% if one looks forward a few years. The shares at a 10p multiple. It's one of the few value situations out there. And it's a share that we would back to give you a pretty good return over the next 12 months.